right, folks, welcome to Freyman CPA. It's been a while since we've done any kind of YouTube videos. I want to take a moment out of my day to just put together something real quick for our viewers out there. And I think that this one is going to be actually a very out of the box one that I haven't seen others do just yet. And today we're going to basically focus on how to read financial statements. And I think that for business owners, this would come in very useful when they're dealing with their annual tax filings, or they're working with their bookkeeper, or perhaps they're working with their CPA, accountant, enrolled agent, what have you. And I want to teach people how to get the most out of those meetings, because it's so crucial for people to understand how to read their financial statements for their business. Now, before we dive in, I just wanted to also give everybody a heads up. When we're dealing with financial statements for a business, I really want you to think of it as no different than reading financial statements for you personally. What do I mean by that? Well, have you ever heard the term when they're speaking of somebody very wealthy, for example, Donald Trump, they say Donald Trump's net worth is so much, fill in the blank, right? When they're speaking about net worth, they're really talking about somebody's personal financial statements, and that's what they're called, personal financial statements. So a business can have financial statements, but so can individuals. It works exactly the same. The accounting principles are identical. And when you're going to go into your next meeting thinking of this in those terms, I think it will benefit you greatly, and you'll be able to really impress your accounting team. All right, guys, so some accounting basics, yeah? So when we're working in the world of accounting and accounting reporting before we're dealing with taxation, in general, what we're really doing is just compiling data. We're bringing in data into a set of accounting records, or QuickBooks Online or what have you, and we're just consolidating everything into little buckets, and we're basically putting everything into its proper shelves and explaining what's happened. We're telling a story, a financial story of where the money went, what we bought, what we spent, what we got paid, whatever. So in our world, when we're dealing with financial statements, there's really two statements that we typically work exclusively with. And those are, and I'm going to write it down for you here, profit and loss statement. And what you see in front of my screen here is a profit and loss. And then we have what we call the balance sheet. Okay. So they're actually working together, okay? And that's really an important concept to understand, that they're interrelated. Now, you've probably heard of people talking about cash flow reports, and there's other types of reports out there. And yes, they do other things, but 99% of the time for small business and everyday stuff, it will not apply. So you'll always be working with a profit and loss in the balance sheet. Now, profit and loss statement is really rather straightforward. It's just basically whatever ins you had in terms of income versus your expenses. Okay, so in this particular case, we're looking at a variance analysis. And before we talk about variance analysis, let's just highlight, let's say, for example, the 2021 column. And all this is telling me is that this is the activity between January and December for 2021. And I like to compare sets of data to give my clients benefit, and for them to be able to understand what's happening, and for them to be able to review things easier. That's also part of our review when we review our work, and when we're going through things in that process. We want to always compare things to where they were prior. Doesn't necessarily mean that whatever was done before was accurate. In fact, sometimes it's not. But that does give us still a lot of indication as to where things should go, and we should always be working with a prior set of information if we have it accessible. All right, so in this case, again, when we're dealing with a profit and loss statement, it's just money in versus money out. Okay, the money coming in is very straightforward. It's just your income. And then we have our expenses. All right, so when you're reading your financial statements, that very first line is just, all the numbers are positive, but in reality, when you're reading these, this is really money coming in, and this is all money going out. So in actuality, if you were to look at it from like a pluses and minuses type of situation, all of these numbers would therefore be negative. And you can set it up different ways. This is just an export out of QuickBooks, and this is how QuickBooks spews out the numbers. Other accounting software might do something more like where you have 250,000 coming in, and then the 4584 for advertising and promotion would be actually a negative number. And that's just a quicker way for people to see, because then you can format the cells to actually look like a number. Let's see, in this format. And that's what people typically see. When you think red, you're always thinking, oh wow, we're in the red. Those are the minus numbers. The black is the positive numbers. We're in the black. It's a good thing we're in the red. It's a bad thing. Yes, if you have more red than you do black, then obviously you're going to be in the minus, right? And vice versa. So that's just the way QuickBooks exports things. So we'll just have to deal with it. But just do understand that the expense side of things are the costs, obviously. And when we're dealing with profit, that's the bottom line. So in this particular case, in 2021, this particular instance, we actually profited 149,000. Otherwise, it'd be a net loss. So yeah, that's straightforward. As far as how to read it, well, we have what we call accounts. So the general and administrative, I like to put our, we're very traditional in nature in that respect, and we like to create parent accounts and sub-accounts and basically make things organized uniformly across the board for all of our business clients, because all of them have advertising to some degree and banking, processing fees and whatnot. So it made sense early on for us to always organize everybody in the same route. And that's kind of how it's done in practice. So we carried on that torch. Now, as far as what you're looking at here, so if we look at it and just dissect it a little bit further, this first whole section here, and I'm going to just highlight it in gray, this is all general administrative expenses. And when we're dealing with general administrative expenses, I'll put things in there like advertising, the banking, dues, subscriptions, insurance, office-related costs, and so on. All right, and then we'll get to our total G&A. Now, so again, this is the general administrative is the main parent account, and then we have nested sub-accounts, and then for some, we even have sub-accounts, right? So we have underneath banking, which is a sub-account of general administrative. We also want to bring in the interest expense, which would be a sub-sub. All right, again, this is really done just for the readers to be able to much better assess where the money is going and be able to really look at things in a much better perspective than if all of this was alphabetized, right? Because I don't know if you guys know this, but a lot of accountants don't bother with the reporting the way it is, and they'll actually just, basically have the, if you open up a fresh set of books, QuickBooks, and you start to just put things into their account, QuickBooks is not going to create parent accounts and sub-accounts and makes things pretty. You have to do that yourself, or your accountant or bookkeeper would do that for you. All right. Otherwise, QuickBooks would just basically have it in alphabetical order for you automatically. And then you'd be looking at something like advertising, banking, dues, insurance, office, and then instead of professional, there'd be something like payroll here, payroll costs, and there would be it would start to get really hard to read because all these different costs are kind of jumbled and just simply alphabetized. So it becomes very hard for a person to really get any kind of value from what they're looking at, because I want to be able to look at financial statements from year to year and say, well, what are my total general administrative costs last year compared to this year? And then further, you can drill in and see if everything's sitting in that right category. Again, this is an export from QuickBooks. So these are just hard numbers. There's actually no data behind them. But if you were in QuickBooks, you would actually be able to drill into this account and see every single transaction that took place for advertising. Okay, that could be hundreds, thousands, whatever number of transactions that's sitting in there, and then you would review that even further. So yes, this is a very good starting point, and this is kind of like that bird's eye view when you're flying from above and looking at everything. But you're still want to go in a level deeper and actually dive into the actual accounts by going into your QuickBooks or other accounting files, or get a detailed profit and loss. So QuickBooks can also export a detailed profit and loss, where it'll actually show everything that went into these consolidated summarized numbers that you're seeing here. All right, and that'll give you better indication if what's sitting in the total account, like this 15,848, if it's really accurate. Because whoever's doing the accounting could miscategorize things and mispost them. And mispostings would be like something like where I'm paying for Facebook advertising and the bookkeeper doesn't know that it's an advertising cost and accidentally puts it to personal expense, thinking that you're buying something for personal reasons off of Facebook. Who knows? So yes, at the end of the day, I want you guys to understand that when you're reading financial statements for your business, at the end of the day, these become your taxes. So that's where it's so important to get in the habit of working with your accountants and looking at the financial statements, trying to understand it from a managerial perspective, and to get the information to be able to make managerial decisions. But also you want to be able to utilize it to understand how much profits you're making from year to year, and to be able to scrutinize information, make sure that it's accurate, because it will go on your tax return. And once it's on a business tax return and you're signing that return, you're signing that tax return under penalties of perjury, which is very serious. So you want to make sure that all these numbers are accurate. And misrepresenting information on a tax return does bear weight. It is basically misreporting, and it's basically lying on the penalties of perjury. So if I was to say to you, all these contractors are really employees, but I want to put them down as contractors on a tax return, but in essence, they're all employees. I just basically lied on my taxes and said, even though it's still an expense, right? An expense is an expense is an expense. So your profits would still be okay. Your taxable income would still be okay. So you're not lying about your taxable income, but it would open up a can of worms that deals with employment, okay? And employment issues such as misclassification of employees and basically lying about it. Because then you're basically saying, well, I know that there's rules out there that I have to classify my employees as employees and not as contractors, but I don't care. I want to call them contractors and I want to pay them as contractors. I want to skip all the liability that comes with employees. So I'm going to misclassify them. Okay, and I'm going to put all those employees through my payroll as contractors. They're all going to get 1099 forms. They're all going to pay their own taxes. I'm not responsible for their taxes. I'm not responsible for their insurance or for anything really. And but at the end of the day, I want to say that these were all employees, on a tax return. At the end of the day, it's still the same cost, but I'm basically lying on the penalties of perjury. So that's why it's important to look at all these numbers in detail and see what's sitting behind the consolidated numbers, because at the end of the day, both you and the accountant are signing on the penalties of perjury. So that's another great takeaway from how to read your financial statements. Look at the details, look at the summary, make sure that things are properly being itemized. Again, this is not a bookkeeping lesson, it's more how to read financials. And so I'm just going to continue on with that topic. But that's basically the gist of the P&L. The P&L is very straightforward. There's, like I said, it's just money in, income, and expenses. And all you want to make sure is that everything makes sense. You're comparing one year to the other to understand, to make internal decisions, to be able to run ratios. Don't forget, you want to also run by industry standard benchmarks and see if you're doing well with your peer as compared to your peers. So in other words, like if this was, for example, a restaurant business, right? And I brought in restaurant sales of 250,000, and my food cost, right? My cost of goods sold would be, let's say, so what did I say? 100,000. Let's say 100,000, right? So what am I going to get out of my sales from my restaurant? Right. So if this is my restaurant sales, and I'm spending, let's say 45,000 as a cost of goods sold, right? This is cost of goods sold, or AKA food purchases. Yeah. So what's the rate? 45%, right? So I want to say to myself, well, is 45% food to total sales? Is that a good benchmark? What are other restaurants doing? And this information is available out there. So it's very easy to figure out what restaurants typically mark up their sales. I'm sorry, their sales for. So this can help you basically structure going forward, saying, hey, I'm paying 45% of my food costs, but in the industry, nobody pays more than 30% for their food costs. I have a problem. because I'm spending too much, unless there's a special situation or circumstance why I'm spending 45%. Like a special year, like there was some sort of, I don't know, like power outage for a month and everything's spoiled. Yeah, otherwise then, there should be no reason as to why you're paying much more than everybody else in your industry. And that's basically a wrinkle in your system. And you want to make sure that you're ironing that out and either raising your sales amounts by increasing prices, or you're bringing down those costs. All right, so that's basically doing not only we're doing variance analysis, but we're doing ratio analysis. And ratio analysis is what financial professionals do a lot of when they're looking at buying stocks, and called financial analysts actually, and they're looking at ratio analysis all day of companies when we're dealing with all sorts of things really, where let's say you want to invest in company XYZ, you don't look at their financial statements, right? If you want to buy PepsiCo, or if you want to buy Nike online, maybe not the best example, let's just say a new company that's coming out and they're about to go public, right? So you want to investigate, you want to look at their prospectus, you want to look at their financial statements that are in those prospectus, and you want to understand what these ratios are saying. And there's different ratios. There's many different ratios. I'm not going to go into all of them. I don't remember half of them because I don't really use it, and it was something that we learned back in college. But I'm not a financial analyst, so in accounting practice we don't typically look at it for those reasons, unless a client specifically asks. Sometimes clients do ask us for things like that, but it's very, very rare, and it's really not necessary. And a lot of the times it's really not applicable to small business, because small business is just very different from large public companies, the way things are done. So something like ratio analysis definitely will benefit you guys, but it won't be like an amazing, eye-opening kind of situation where you're getting something out of it. You're probably not going to be able to apply a lot of them when you're dealing with small business, but it's definitely something you should still understand. And this, food purchases to total restaurant sales is a great example of ratio analysis that might actually apply to small business. Again, it doesn't have to be the cost of goods sold. It could be the salaries to income. Are you paying, where's most of the money going? And sometimes you don't even need to do a ratio analysis. You can just say, I'm paying way too much in payroll. I can just see it. I didn't make a dime last year. So again, this is used not only for that, but again, you want to see what the profits are. And again, this all just circles back to really getting your information as to what's happening internally, and to make those internal decisions and how it's going to play out for your taxes. Okay, so first, when you're opening up your financial statements, you want to look at your P&L. Again, I'm assuming you have a qualified bookkeeper, or you haven't done the work yourself in such a manner that it's unreadable. Some people do that. They start off, they don't look at the end product. They're just entering data into QuickBooks, not really understanding where it ends up. And this is where it ends up. So, garbage in, garbage out. If you have a good qualified accountant doing the accounting, then you'll be able to get a lot of information and really rely on what's sitting there, because it's only as good as whoever prepared this data.